Alcon decisively beat consensus estimates for Q2 2026. Core EPS came in at 84 cents, which beats a 76-cent consensus estimate by an 11.2% margin. Net sales hit $2.78 billion, beating expectations of $2.76 billion. That's an 8% reported increase, or 7% in constant currency year over year. And management raised full-year core EPS growth guidance to a 12 to 15% range, up from 10 to 13%. And they raised core operating margin expansion to positive 90 to 190 basis points, while maintaining net sales growth guidance at 5 to 7%. The market rewarded the print immediately. Shares surged 6.31% in after-hours, trading to $62, and ultimately closed up 5.97% at $61.80 the following day on really high volume.
Yeah, when you look at that immediate price action, I mean, it's clear Wall Street prioritized the raised guidance and that core operational beat. Institutional investors just look right past the noise in the gap numbers. They focus purely on the underlying cash flow and the improved profitability outlook.
Right, but okay, let's unpack this, because you really have to look closely at those gap numbers.
Yeah.
The discrepancy in this report is just massive. We just established that core EPS was 84 cents, but GAAP EPS came in at exactly 0 cents.
Well, it's down from 35 cents a year ago.
Exactly. I mean, how does a $34 billion company generating nearly $2.8 billion in quarterly sales report an operating income of just $11 million?
Well, it all comes down to that total wipeout of GAAP profit, which was driven by a massive $505 million non-cash impairment charge.
Wow.
Yeah, post-tax, you are looking at a $287 million hit to the bottom line. And this stems directly from management's decision to completely discontinue the PowerVision accommodating intraocular lens program.
Because of the clinical data, right?
Exactly. They explicitly cited inconsistent clinical data as the reason for just pulling the plug entirely.
So we need to examine this market reaction. I mean, it's like writing off a $500 million bad bet at the racetrack. But everyone is cheering because your other horses are running well. Is Wall Street just giving management a total free pass on a massive R&D misstep here?
It looks like a free pass on the surface, sure. But what's fascinating here is how it actually comes down to the mechanics of corporate valuation, right? And how analysts treat sunk costs. The market isn't forgiving the failure.
They're just looking past it.
They're reevaluating the future. That $505 million is gone. It was spent over years of research and development.
Right. And from an accounting perspective, instead of expensing all those R&D costs as they happened, Alcon capitalized them, right? They just sat on the balance sheet as an intangible asset, assuming one day this PowerVision lens would actually make money.
Spot on. And the moment that clinical data came back inconsistent and management decided to scrap it, accounting rules dictate that the asset is now worthless. It has to be written down to zero.
Hence, the $505 million charge hitting the income statement today, wiping out the GAAP earnings.
Exactly. But this is the crucial part for you to understand as an investor. It is a non-cash charge. Alcon did not write a check for $505 million this quarter. That cash left the building years ago.
So the damage is entirely in the rearview mirror at this point.
Yes, and financial markets are inherently forward-looking pricing mechanisms. Analysts aren't valuing Alcon's stock based on the capital lost on PowerVision yesterday. They are pricing it based on projected future cash flows.
Got it.
So by officially scrapping a failing program, management is actually signaling strict fiscal discipline. They're removing a massive future R&D drag. They won't be pouring, tens of millions of dollars into clinical trials next year for a lens that doesn't even work.
Right. So by admitting defeat and taking that accounting hit today, they basically guarantee that their projected future margins improve. They just stop the bleeding.
Exactly. Wall Street loves certainty and they love margin expansion. Killing a doomed project provides both of those things. It clears the deck, and that capital can now be redirected to programs with a much higher probability of commercial success.
Okay, so management ruthlessly cut the dead weight of the PowerVision project to protect those future margins. But you can't just shrink your way to a $2.78 billion quarter.
No, you definitely can't.
They had to be playing aggressive offense somewhere else in the portfolio.
Yeah.
So let's look at the revenue engine, starting with the segment breakdown. The surgical segment brought in $1.57 billion, which is up 8%. And here's where it gets really interesting. Within that segment, equipment sales were the absolute standout. They surged 26% to $279 million.
Driven heavily by the recent launch of the Unity platform.
Right, but the implantables division barely moved. It grew only 2% to $466 million. Management noted this was hindered by competitive pressures and a generally soft cataract procedure market.
Yeah, and that divergence, I mean, a 26% jump in equipment and just a 2% crawl in implantables, it tells a very specific story about hospital capital allocation right now.
It fundamentally updates the way we should view their sales model. I mean, historically, we always talk about medical devices using the razor and blade model, right? You sell the machine cheap, you make a fortune on the disposable tools used in the surgery.
Right, the classic model.
But it's like selling a record number of state-of-the-art high-end coffee machines, that's the Unity platform, but seeing sluggish sales on the coffee pods themselves, the implantables.
That is the perfect way to frame it.
Oh.
Because selling the Unity platform isn't like selling a coffee maker to a clinic. It is much more like installing a proprietary operating system into a hospital surgical suite.
Oh, that makes sense.
When a hospital commits to the Unity platform, they are fundamentally altering their infrastructure. They are bolting a multi-million-dollar machine to the floor, sure,
Correct.
but more importantly, they are training their entire surgical staff on its specific software interface.
And its specific feedback mechanisms, too, I imagine.
Exactly.
So the switching costs just become astronomically high.
Astronomically high. Once that equipment is installed, the clinic is locked into the Alcon ecosystem for years, retraining an entire staff of surgeons and nurses on a competitor system a year later. That is a logistical and financial nightmare for a hospital administrator.
So that 26% jump in equipment sales is highly encouraging because that revenue is extremely sticky. It represents long-term market share capture.
Precisely.
But that brings us to the counterweight here, the 2% growth in implantables. These are the high-margin consumable lenses used in every single surgery. If hospitals are buying the equipment at a record pace, why aren't they buying the consumables to use with it?
Well, because of the macro environment, management specifically called out a soft cataract procedure market. That means fewer patients are actually walking through the clinic doors to have surgery right now.
Which creates a temporary lag.
Right. Clinics are upgrading their hardware, but the immediate utilization of that hardware is low.
Which raises an interesting point about hospital strategy in general. I mean, why would a clinic drop millions on new capital equipment during a soft market when patient volume is low? That seems counterintuitive.
It seems that way, but it is actually the most logical time to undergo a major upgrade. Think about it. When patient volumes are bursting at the seams, a clinic cannot afford to take an operating room offline for days to install new platforms and run training seminars.
Oh, right. The downtime just costs too much in lost revenue.
Exactly. So a soft market provides the operational breathing room to install the Unity system. They're essentially remodeling the store while foot traffic is light, preparing for when volume inevitably returns.
And Alcon is just successfully capitalizing on that downtime to push the hardware. That is smart. But we also have to look at the other side of Alcon's business, the vision care segment.
Right, which also performed well.
Yeah, it hit $1.21 billion, up 8%. Ocular health spiked 13% to $486 million. And management highlighted strong momentum from dry eye products, specifically the new launch of Triptire and their legacy Sustain franchise.
Both very strong performers.
And contact lenses grew 5% to $726 million. But the underlying mechanics of that 5% growth are critical to understand. They achieved that top-line growth because product innovation and price hikes successfully offset declines in their legacy lens products.
Yeah, so they are managing a declining volume base by basically squeezing more revenue out of the customers who remain.
Exactly. Which raises a major question about the elasticity of demand in the contact lens market. I mean, how high can Alcon raise prices on consumers before they simply trade down to a generic or a cheaper competitor?
You have to look at the specific moat around contact lenses compared to other consumer health products. Like, if the price of a brand name painkiller goes up, you can just grab the generic version sitting right next to it on the pharmacy shelf.
So the switching cost is basically zero.
Right. But contact lenses are highly regulated medical devices. In the U.S., your optometrist writes a prescription for a specific brand, a specific curvature, and a specific material.
So you can't just swap it out at the checkout counter.
No, you can't. If you want to switch to a cheaper competitor because Alcon raised the price of your lenses, you have to book another appointment with your eye doctor, pay a copay, undergo a new fitting process, and get a whole new prescription.
Wow, okay. That structural friction gives Alcon immense pricing power. Consumers will tolerate incremental price hikes simply to avoid the hassle and the cost of going back to the doctor.
Exactly. But there is still a ceiling. Pricing power is a great muscle to have in an inflationary environment, but it is not infinite.
Right. If you push the price too high, the savings of switching to a competitor eventually outweigh the friction of booking that eye exam.
Precisely. And what you are seeing right now is Alcon aggressively threading that needle. They are utilizing their pricing power on legacy lenses to maintain top-line growth while they rush to get new innovations like Dripter to market to take over the heavy lifting.
And they are executing that transition while actively expanding their profitability, which is impressive. Let's connect this top-line growth back to the margins because the numbers here demonstrate serious operational leverage.
They really do.
Core operating margin improved to 20.6%, which is up 150 basis points year over year. First half free cash flow was solid at $693 million, and they are aggressively returning that cash to shareholders.
Yeah, $538 million returned year to date.
Right, via dividends and buybacks. And they still have $1.2 billion remaining on their $1.5 billion repurchase authorization.
Look, 150 basis point margin expansion while simultaneously growing the top line at 7% in constant currency, that is essentially the holy grail for a mature medtech company.
It really proves that the business is scaling efficiently.
Exactly. For every new dollar of revenue coming in the door, a fundamentally larger percentage of it is flowing straight down to the bottom line rather than just being eaten up by operating expenses.
But there is a massive geopolitical caveat buried in this margin guidance we need to talk about. Management warned of a full-year tariff impact of $40 million to $90 million, assuming 10 to 12.5% U.S. import tariffs remain in effect. That is a very real hit to their cost of goods sold.
It is, yeah.
However, they also anticipate a $60 million refund from the U.S. government in the third quarter based on current trade regulations. And the strategic move here is what they plan to do with that check.
Right, they aren't just sitting on it.
No. They plan to reinvest roughly 2/3 of that $16 million directly into accelerating product launches. Specifically, Treve Peak YR, Valeda, Unity CS, and PanOptix Pro.
If we connect this to the bigger picture, they are essentially weaponizing a government refund to fund a marketing blitz.
So what does this all mean? Doesn't relying on a projected government refund to fund your key products rollouts introduce an unnecessary level of political risk into your operating model? I mean, bureaucratic delays happen all the time. If that check gets held up in Washington, does their product pipeline just stall out?
It would be a massive risk if they were structurally dependent on that money, but the margin guidance proves that they aren't.
How so?
Well, they raised their core operating margin guidance for the full year while explicitly baking in those tariff assumptions. That tells you the underlying business is running so efficiently that it can fully absorb the $40 to $90 million tariff hit and still expand overall profitability.
Oh, I see. So the base business is secure regardless of the refund.
Correct. The expected $60 million refund is purely discretionary upside. Management isn't saying, we can't launch these products without the government check.
Right.
They're saying, if we get this $60 million back, we aren't going to just let it sit on the balance sheet or use it to buy back slightly more stock. We are going to aggressively inject $40 million of it into targeted sales and marketing to supercharge 4 specific product launches.
So it really dictates the velocity of the rollout, not the viability of it.
Exactly. If the refund is delayed by some bureaucratic nightmare, they simply dial back the aggressive promotional spend. It doesn't break the operating model at all.
That's a highly agile capital allocation strategy.
It is. They are successfully defending their margins on the base business while just keeping their powder dry to aggressively attack the market the moment the capital frees up.
Which brings us back to the overarching strategic tension we've seen throughout this entire report. There is a delicate balance between pushing new innovation into the market and relying on the market's capacity to actually absorb it.
Right, it's a tightrope.
Because we've established that management is facing headwinds with a softness in the cataract procedure market. Yet despite low patient volume, Alcon is incredibly successful at pushing high-end capital equipment, like that Unity platform, into those very same clinics.
It really sets up a fascinating dynamic for the broader medical device sector over the next few quarters.
It really does. Because the ultimate question for you to consider as you update your financial models is this. If patient volume doesn't rebound quickly to meet that newly installed surgical capacity, will these clinics be forced to pull back on future capital expenditures, effectively choking off Alcon's equipment growth?
Or, by pushing this hardware during a lull, is Alcon actually perfectly positioning these healthcare providers ahead of time, ensuring they have the premium technology bolted to the floor and ready for the inevitable, massive demographic wave of aging patients?
That tension between immediate utilization and long-term demographic trends is definitely the defining metric to watch. We'll be closely tracking exactly how those procedure volumes trend in the coming quarters. Make sure you follow the show for our daily earnings coverage and ongoing deep dives into the markets.